eBay is the perfect example. You really need to go back and study, and you should have a number of these that you kind of always keep going back to as how the markets will bottom. So now eBay was, like so many of these recent stocks, was a recent IPO, had this huge run up. This is obviously split adjusted, so it wasn't 86-cent stock, but you went from 90 cents to $11. Staggering moves, obviously .com era stuff. Topped in March 2000 with the general market, reversed lower, and we went to this big bad bear market. Let's take a look here. So from March 2000 to December 2000, that's 78% drop. Now, how did this stock become viable? So obviously, of all of these stocks that blew up from the COVID stocks, or I call them COVID stocks because that was the bull market, that was the era. But a lot of them are just technology companies or biotech companies, and some of them have some astounding technology, amazing products, and they're going to come back and do very well. But how are we going to be able to buy them safely and at the right time? Now, even if you did want to buy eBay in this area here, the market went much lower. This didn't go any lower. But if you bought it in November 2000, November 27, let's say you bought on the close of that week, which was pretty close to the bottom, you had to sit with that from November of 2000 until April of 2001 and not go anywhere. And you had to sit through all of this volatility, which is very, very difficult. And you had to sit through a market that kept breaking lower and lower and lower and lower, and not get scared at any point and kind of get shaken out and lose your stock. Now, the point where this really started to get interesting, I mean, and look at these swings. I mean, even if you bought it here at 355, you rallied up to $7 and you crashed all the way back to the $4 again. Very, very difficult until it was really the right time to buy the stock. But look at the way this stock actually bottomed. Obviously, this is a very long-term basing phase, which it does happen every so often. I hope it doesn't take this long to happen, but the market kept falling and falling and falling, and eBay didn't fall anymore. It just kept climbing and kind of tightening up. But what's important, this is why we have these rules about the shaper patterns. If you take a look at these drops, this is a 43% drop. It's too deep, and they're prone to failure. So with a drop like this, you said, oh, now the bottom's really in. Even if you bought it as it came through the 10-week line, and you're patient, and you bought at $6, you had to you bought that at October 2001, and you were still in the same place in October 2002. So you had a year again of sideways chop, up and down, earnings reports to worry about, market falling lower and lower and lower and lower. Very, very difficult. So when you finally formed a proper basing structure, let's take a look here. Only 21% deep. Very, very nice. Let's take a look here. 1 second. At about a 30% prior uptrend rally. So the market had been coming down. You hit another bottom. You rallied 30%. You corrected only 21% this time, but it was shallow. This was the first shallow base. So you're looking at this chart, and this is really where it comes down to the untrained investor to the trained investor. To someone who's untrained and doesn't know what's the difference. A pattern's a pattern. What difference does it make? It's the same thing. It's a cup. It's a stall bar. It's a support week, whatever. No, it's not. The percentages make a very, very big difference. If you have these 43% declines, you have to almost double the stock to get back to the prior high. At that point there's so many people sitting with gains. They're going to sell that stock, and then you come under a lot of pressure again, and they don't work very well. For every 40% plus deep base that works, you're going to get 10 that fail. Very low probability base. Anything over 35%, I just don't want to deal with it. I've had too much trouble. And so you finally had a very nice double bottom. You actually had a double bottom within a double bottom. Let me just draw that in for people who are not so accustomed to seeing that with their eyes. So that was your double bottom base, but you also had another kind of shorter, but still technically correct double bottom within the double bottom. So you had kind of two double bottoms there. And this is the base that worked. Now, let me just get back to my chart here. And look at this beautiful advance that we went under. Look at that. Significant advance. You went from, we'll call the official double bottom breakout here of 6.25. What was the high of this double bottom? 608. Call it 6.25. And from there, you went up to $23. Now, what's the big difference? Take a look at this advance and take a look at all this price action. This one chart can teach so many lessons. Number one, you want to see this period of time where the stock shows this AB relative strength. Market breaks lower, the stock doesn't break lower anymore. Two, you need a prior uptrend before your basing structure is always a plus to have, unless it's a really giant washout. Sometimes that's a reason that you don't get a prior uptrend. For example, the COVID crash, there won't be a prior uptrend to that. But if it's a kind of a slow grinding bear market like this example, you'll typically get prior uptrends as the stock is outperforming the market. The third important lesson is that the base has to be shallow. You can't be over 35% deep. As soon as, even though there's some stocks on the leaders list that maybe are a little bit deeper. Let me see, for example, here, leaders list here. Let me look at as an example that I have, let's say a Palo Alto, or say Fortinet. See, it's only 24%. That's why it's on the list. I think I have CrowdStrike or SI. I was watching SI just as, again, just to have some kind of exposure to the crypto space. With these kind of drops, there's no way this is buyable. If this would have formed the proper shallow base and turn, it could have been interesting, but now there's no way this is buyable. And you have to be patient for those proper bases. Doesn't mean you can't watch the company out of interest to learn about the technology and what they're doing and how they can potentially be leaders, but they're not buyable yet. So you need to have a point in time where it starts to have the AB relative strength, shallow base. But the other important thing, and you need to train your eye to this, because this is really understanding the different phases of the stock. And Stan Weinstein does a good job of talking about the different phases of a stock. And this is the accumulation phase of the stock. This is where really you want to be participating. Look at how much lower the volatility is on the accumulation phase versus everywhere else. It just pops. Once you get your eye to be accustomed to that, you almost can't see, you cannot not see it anymore. And look at how wide and wild, look how big the bars are in price action here. If you kind of zoom in a little bit, look at how wild this price action is. Look how wide each bar is, high and low the week is. You go from, what is this here? From 588 to 515. Those are big percentage drops. And then once you come under accumulation, look, high and low is 710 to 669. Or the high and low here is 704 to 672. It's like the volatility is gone because there's a heavy, deep pocket institution or group of institutions that realize, okay, eBay is going to be a big performer. All of the low price stock has been purchased over all of this time. People with big pockets keep buying and buying and buying until there's just no more sellers left. And then after, institutions don't want to run the stock up. As individual investors, you want to see your stock rocket and take off. An institution needs to put on that position. They want to see calmness, so they just slowly buy. And it's not in the short seller's interest to try and smash the stock lower because they know they won't be able to cover. And you get this low volatility, slow advance that just keeps going and going and going and going and going and going until it finally breaks. Now, not only is this advance significantly larger than these little bear market rallies, you go from 6 to 24, you quadruple. But what's important is on a risk adjusted basis, it's off the charts. I mean, you can establish a position with very low risk. Even if you miss this double bottom, you could have bought a flat basing structure as touch a 10-week line. And so you have very low risk, very low downside risk. You have a lot of time to put on additional buy points as the stock accumulates, advances slowly. And so you could very conceivably have a 30, 40, 50% of your account exposed in a stock that quadruples. And in 2 years, that means moving up your whole portfolio up by 200, 300%, which is a staggering advance with one company. And so again, you want to look back at other bear markets, or you want to look at all the great companies that exist today. Even some people say, well, I don't know what stock to look at. All of the great companies that are out there today, all of the FANGs, all of the oil companies at one point had their accumulation phases of their life cycle. Look at these uptrends and train your eye about how much lower the volatility is, how the whole character, suddenly this looks like, oh, there's a great tech stock. Fantastic. You look here, and this is what people have said, like, oh, that looks like an oil company. It just doesn't go anywhere. And so it's not that it's an oil company or it's a tech company. It's what phase of the accumulation, what phase of the stock cycle are you in? That's really what drives the kind of price action you're in. And that to me is the most obvious demonstration that I could show that institutions dominate stocks. And when institutions come as a collective to be net buyers, this is what happens. And when that ends, well, the same kind of stuff happens. See, once it loses its throne and they realize that the growth is gone, suddenly the volatility comes back, and then that's time to get out of Dodge.